All right, let's dive right into this explainer. Today, we're completely unpacking India's digital financial regulatory architecture in depth. We're going to detail exactly how liability works in digital payments, and then explore how the legal system maneuvers around the highly complex, often frankly confusing, gray zone of cryptocurrency. So, if you've ever wondered how the law keeps up with tech that literally changes by the minute, and how exactly you're protected or exposed in this ecosystem, you are absolutely in the right place. To completely unpack all of this, here's our game plan. We'll look at UPI scale and risks, who bears fraud losses, and prosecuting digital payment fraud. Then we'll shift gears into the crypto legal vacuum, the Supreme Court intervention, and finally, regulation by adjacent means. Starting off with part 1, UPI scale and risks. We're talking well over 1 billion transactions managed every single month under the Reserve Bank of India's umbrella. To put that into perspective, that volume regularly eclipses many of the massive global legacy credit card networks. It's a staggering achievement in financial inclusion, for sure. But, well, there's a flip side. UPI is simultaneously the nation's flagship digital payments success story and single largest surface area for financial cybercrime. When a system gets this ubiquitous, the target painted on its back grows exponentially. We aren't just talking about a few stolen passwords anymore. We're talking about industrialized, high-volume digital fraud operating at a scale that mirrors the network itself. And that staggering scale brings us directly to the most practical, real-world legal question any consumer faces when they get tricked or compromised. When the money vanishes from an account, who actually pays? Are you on the hook, or is your bank? Which brings us to part 2, who bears fraud losses? You might expect a simple blanket rule here. Something like, the bank always pays, or the customer is always at fault. But the RBI doesn't play it like that. A rule like that would either bankrupt the institutions or completely destroy consumer trust. Instead, they use a carefully graduated liability ladder. It meticulously weighs where the fault actually lies, and crucially, how quickly the victim reacts to the fraudulent transaction. Let's actually break down how this ladder works in detail. First, you face zero liability if the bank system is inherently breached and you report it promptly. The bank just absorbs that cost. Now, you get limited liability, which usually means your loss is capped at a modest fixed amount. If the breach was due to your own negligence, like accidentally sharing an OTP, but you still managed to report it within a very short specified window. However, you face full liability if the loss is directly tied to extreme negligence. Think actively approving multiple payment requests from a scammer while ignoring warning prompts and then completely delaying the reporting past the outer time limit. In that worst-case scenario, the financial burden shifts entirely to you. Notice a pattern here? The crucial point is that this entire liability framework revolves entirely around what we call the golden window of reporting speed. This isn't just bureaucratic red tape, it's a strict operational reality. This is exactly why India's national cybercrime reporting infrastructure, specifically the 1930 helpline, focuses heavily on immediate transaction freezing rather than after-the-fact investigations. If you report it within this golden window, authorities can actually place a lien on downstream mule accounts. They literally freeze the funds technologically before they can be withdrawn at an ATM or swapped into crypto. If you wait days to report it, that money has already bounced through 5 different accounts, and the chance of recovery is basically zero. Moving right along to part 3, prosecuting digital payment fraud. Okay, so once a victim successfully navigates that golden window, how do the actual legal mechanics of criminal prosecution kick in? Standard phishing and identity theft hit the IT Act sections 66D and 66C, along with basic BNS, the Bhartiya Nyaya Sanhita, cheating laws. But, and this is a massive distinction in modern law enforcement, when prosecutors are dealing with huge syndicate operations, those highly orchestrated fake KYC setups, or terrifying digital arrest scams, they invoke the much more severe BNS Section 111 for organized crime. This statute carries significantly harsher penalties and legally recognizes that these aren't just lone wolves in a basement. We're talking about sophisticated corporate-level criminal enterprises. All right, shifting gears now to part 4, the crypto legal vacuum. We've got to state this foundational fact plainly, right out of the gate. India still has absolutely no dedicated, comprehensive statute regulating cryptocurrency. Back in 2019, an interministerial committee actually drafted a bill proposing hard prison time just for holding crypto. But it was never tabled, it never passed, so today, holding, trading, or utilizing these digital assets remains in a genuine, persistent legal gray zone. There is literally no official rulebook defining what this asset class fundamentally is. This friction leads us perfectly into Part 5, the Supreme Court intervention. Nature abhors a vacuum, right? And so do financial regulators. This absolute legislative void naturally led to intense friction. Mapping this out chronologically gives us amazing context. In 2018, the RBI stepped in and issued a circular that effectively severed banking access for all crypto exchanges. They didn't outright ban crypto, they just banned banks from dealing with crypto businesses, completely choking off the industry's fiat currency lifeline. That drastic move triggered a massive legal pushback, culminating in the landmark IMAI versus RBI Supreme Court judgment in 2020. Let's look closely at that 2020 Supreme Court showdown. In an exhaustive 180-page judgment, the court confirmed that the RBI absolutely had the statutory power to regulate virtual currencies to protect financial stability. But they struck down this specific 2018 banking ban. Why? Because it failed the constitutional test of proportionality. The RBI couldn't produce empirical evidence showing actual quantifiable damage to its regulated entities from these crypto exchanges. A total banking prohibition was deemed a disproportionate response. It was basically using a sledgehammer to crack a nut, especially when less restrictive alternatives like enhanced KYC weren't even tried first. Now, pay super close attention to this because it gets misunderstood by retail investors all the time. That judgment did not declare cryptocurrency legal tender. It did not bless it as an officially recognized asset completely free from future regulation. It merely removed a disproportionate banking ban. It left the underlying legislative vacuum completely intact. The Supreme Court essentially pointed right back at the government and said, Parliament needs to decide the fate of this tech through actual legislation. You can't just enforce a backdoor banking ban. So, how is it handled now? That brings us to Part 6, regulation by adjacent means. If Parliament didn't write a direct crypto law and the Supreme Court only handled the banking access issue, how exactly is the government asserting control over this frontier today? Well, it's a textbook strategy of regulation by adjacent means. They started with the Finance Act of 2022. They hit the space with a steep, flat 30% tax on income from transferring virtual digital assets. Even more importantly, they introduced a 1% tax deducted at source, or TDS, on transfers. This 1% TDS is brilliant from a regulatory standpoint. It forces exchanges to deduct the tax at the exact moment of the trade, creating an unavoidable, real-time paper trail. It gives authorities complete visibility regardless of whether a trader actually declares the transaction on their year-end tax return. And when you compare this side by side with ordinary capital gains, wow, the government's true intent becomes painfully clear. This tax is deliberately punitive. Let's look at the math. With ordinary capital gains, you can claim deductions and set off your losses against your gains. But under the crypto tax regime, no deductions allowed, except the cost of acquisition and absolutely zero set-off of losses. Think about it. If you make $1,000 trading Bitcoin but lose 1,000 trading Ethereum, under normal rules, you break even and owe nothing. Under India's crypto tax, you can't set off that loss. You still owe a 30% tax on the Bitcoin win, and you just have to swallow the Ethereum loss entirely. It's designed to act as a massive financial deterrent, not just a way to gather revenue. Building right on top of that shadow regulation, the government then utilized the PMLA in 2023. By officially designating crypto businesses as reporting entities, they dragged these exchanges kicking and screaming into this strict anti-money laundering compliance perimeter. This mandates rigorous KYC protocols, long-term transaction record keeping, and mandatory reporting to the Financial Intelligence Unit. The irony here is literally palpable. Crypto exchanges in India are now regulated as heavily as traditional banks for money laundering purposes, despite the fact that the digital asset itself still has absolutely no dedicated legal recognition. So, as we wrap up this explainer, we're left staring at a pretty massive question. With the government effectively building this giant de facto compliance wall through punishing tax structures and stringent AML laws, what is the ultimate future of these digital assets? Can decentralized technology truly thrive, or even survive, in a financial system that regulates it entirely by adjacent means without ever offering clear legal definitions? It's a fascinating frontier. The rules of the game are literally being written in real time, and the stakes for digital finance couldn't possibly be higher. Keep questioning, keep learning, and I'll catch you in the next explainer.